Welcome to the Explainer. Today, we're doing a full financial teardown of Senshu Electric's 2025 results. They're a major player in Japan's electrical wire and cable scene, and we're going to dig in to see what the numbers really tell us about their year.
Okay, so here's our game plan. First, we'll look at the economic storm they had to sail through. Then, we'll check out their financial report card for the year. After that, we're going to see if the company's foundation is solid, follow the money to see where it went, peek at their strategy for the future, and wrap it all up with what this means for investors. Let's get into it.
All right, first things first. You got to remember, no company exists in a bubble. And for Senshu Electric, man, they were facing some serious economic headwinds this past year. The whole economic picture was pretty murky, to say the least. You had this constant risk of a slowdown, financial markets were all over the place, and that really puts a chill on business confidence.
Now this is a huge deal. The average price of copper, which is like the main ingredient for their products, jumped by almost 5%. That puts immediate direct pressure on their costs. That's a hit they have to absorb right away.
So on top of paying more for their raw materials, demand from their biggest customers, we're talking semiconductor and machine tool industries, was pretty sluggish. The auto industry was taking its sweet time to recover, and big construction projects were getting delayed. It was just a really tough environment to be in. Okay, so with that pretty challenging backdrop, how did Senshu Electric actually do? Let's get to the numbers and see how their scorecard looks. First up, sales. And you can see here, they stayed incredibly steady. I mean, they only dropped by 0.4%. So with all those headwinds we just talked about, they somehow managed to keep their sales numbers up. But, and this is a big but, that is definitely not the whole story. And here it is. This chart shows the real challenge they were up against. While their sales were basically flat, their operating profit took a nosedive, falling by a pretty significant 13.5%. So what gives? Why the huge gap between sales and profit? Well, it all comes back to those pressures we talked about. That spiking copper prices, plus other rising expenses, just squeezed their margins. It's like they were running in place, working just as hard to sell things, but making less money on every sale. Now, seeing a double-digit drop in profit might sound some alarm bells, but it's really just one piece of the puzzle. To get the real picture, we need to pop the hood and look at the balance sheet to check the company's overall financial health. And this is what you find. This number is their equity ratio. In simple terms, it means that over half the company is funded by its own money, not by debt. That is a very, very strong sign of financial stability. And get this, it actually got better from the year before. So, the company's built on a solid foundation. But what about the lifeblood of any business, cash? Let's follow the money and see the story it tells. And we can do it with three key numbers. First, they generated over 9.4 billion yen in cash just from their core business operations. This is the engine of the company, and it's showing us that the engine is running strong. It's pulling in a ton of cash. So what did they do with that cash? Well, next, they spent 3.8 billion yen on investing, things like buying new assets and securities for the future. This shows they're not just sitting on their money, they're putting it to work to grow the company down the road. And finally, they use another 3.7 billion yen on financing activities. Now, this is where you see stuff like paying out dividends and buying back their own stock. This is cash going directly back into the pockets of the company's owners. So here's the crucial takeaway. The business is a cash-generating machine, and management is using that cash in a really smart, balanced way, investing in the future while also rewarding the people who own the company today. That's a healthy cycle. So a tough year is in the rearview mirror, but management seems to be looking ahead with a lot of confidence. Let's take a look at their official forecast for the next fiscal year. And whoa, they are forecasting a really strong rebound across the board. Sales are expected to jump over 6%, but look at that operating profit. They're projecting it's going to leap by almost 20%. That is one confident forecast. So after a tough year with falling profits, but with this really confident outlook, what does it all mean for the owners of the company? This, right here, is where the story comes full circle. Get this. Despite that drop in profits we saw earlier, the company increased its annual dividend. It went from 130 yen per share last year up to 150 yen this year. They gave their shareholders a raise. And that is such a powerful signal. Raising your dividend, especially in a year when profits are down, is basically management putting its money where its mouth is. It says, we are so confident about our future cash flow that we're going to give more back to you right now. And that's really the key takeaway from this whole thing. If you just look at the headline, you see profits down. But when you dig deeper, you find a super stable, cash-rich company that's investing in growth and confidently rewarding its owners. It really makes you wonder, what exactly do they see coming over the horizon?